Good morning, everybody, and thank you very much for joining us today for the Nedgroup Investments Opportunity Fund quarterly feedback. I'm really pleased to have Omri Thomas with us on the call today. Omri, thanks for joining us this morning.
Thank you, Rob.
So everybody, I'm not sure who's joined already this week, but we're doing a slightly different format. Is that Omri's going to talk us through a few slides and give us the lowdown of what's been going on in the first 3 months of the year. But as you'll see at the bottom of your screen, if you're using Skype, you will be able to ask questions. So please post a question. Nobody else will be able to see it, and I will be able to filter through those, and I'll direct those to Omri at the end. If anybody's having trouble seeing the presentation, we've also added that as an attachment. The three blue buttons at the bottom, there's the one with the arrow. If you click on that, it says you'll be able to manage content, and you can download the presentation from there in PDF format. So it's not a very big file to use. But I'll take Omri through the slides. Omri, if you can just reference which slide you're on. But on that note, I'm going to hand over right now to Omri. And once again, thanks very much for joining us.
Good morning, everyone, and thank you for joining the call. What I'd like to do today is to take you through the performance update on Opportunity and just put that into context. Just give you a rundown on what we see the global environment like at the moment, bringing it back to the SA environment, and then just looking at how the portfolio is positioned, given our view on the fair values of the different asset classes. So I think on the first slide, looking at the performance update, it's been a very disappointing period for us. We try and achieve an inflation plus 5 target over rolling 3 years, and not to have negative returns over any 2-year period. So it's a dual objective, and normally we try and achieve that with tilting the portfolio from a downside protection when we think markets are expensive, and tilting it towards upside participation when we think markets are looking attractively valued. Now, when we got to the end of last year, the SA market specifically was starting to look very attractively priced. More than half of the all share was trading at levels below where they were 5 years ago. You were finding shares that were trading at price earnings ratios below their dividend yields. So we started to see quite a bit of value in the market, and quite a lot of upside potential. And for that reason, we increased our equity exposure close to the maximum limit. Now, normally we'll have quite a bit of hedging over our portfolio, but the hedging comes with a cost that you cap the upside. And because the view was that we were looking to capture quite a bit of that upside, our level of hedging was lower than what it would normally have been. The biggest impact on that was Sasol. So we had a big Sasol position, and we had a hedge that ran all the way from 400 Rand down. So as Sasol fell, up till when the hedge expired, we got protection all the way down to 300 Rand a share when the hedge expired. At that point in time, our view was that Sasol was offering significant value. We were at the end of the Lake Charles capital spending project, and those disappointments of overspending and late commissioning was behind us. We were of a view that they were going to generate about $50 million of cash, EBITDA cash per month from Lake Charles. And on the normal operations, we were looking at about 35 Rand a share of earnings predicted. So we valued the local operations at over 300 Rand a share, and Lake Charles operations at about 150 Rand a share. So we were of a view that there was significant upside in Sasol. Now, with the corona pandemic hitting, there was a dual shock then in the oil market, in that there was a collapse of demand simultaneous to a massive oversupply, exacerbated by ego war between Russia and Saudi Arabia, which led to significant oversupply of oil into a weak market, which put a lot of pressure on the dollar oil price, to the extent that it went below the cost of production of Sasol. Sasol's cost of production is about $35 a barrel, and the oil price went below $20 a barrel. Now they hedged a lot of about 80% of the production at $32, so which will protect the earnings to some extent, but the risk of a lower oil price for a while longer, as there's overproduction in the world, remains. So our Sasol exposure also impacted the portfolio significantly. What was very disappointing was our Stoxx note basket that I've spoken about before. There is capital protection that's embedded in that basket, and two of our biggest notes were expiring in March and April, and both those notes were significantly in the money, and we were going to earn handsome returns from that. Because of the coronavirus, the European market was down 30% over 30% in the month of March. So all that accrued value in those two notes basically disappeared, and it went back to the capital protection level and even below that. So some of those notes now roll into the next year, so it's not a permanent capital loss yet. One will have to see how the Stoxx market perform to expiry, and if the market recovers a bit, we will get all our capital back at the end of when those notes expire. So it is also a timing issue, but it was particularly bad to have lost all that accrued performance that would have now been paid out. And I think the last area that really hit the fund was within the SA market that we saw as very attractively valued. The banking sector specifically was very attractively valued. The banks were trading at PEs of 7 to 8 times, with dividend yields above that. And our forecast on earnings growth was sort of low single-digit growth. So very low expectations were baked into the banks. Again, because of the concerns arising from the corona pandemic, investors are worried about the impact on the bank's income statements and on the level of bad debts. And the banks then took another leg down and went as low as 2 to 3 times PEs on historic earnings. But we know that forward earnings are going to be under pressure. Standard Bank reported their results in the last week, and even before the full impact of the coronavirus, earnings were already down significantly because of the impact of March. Now, April will probably be the biggest impact for most businesses and banks included. So, I mean, it sounds like a lot of excuses, but I just had to put into context why the performance has been quite disappointing. Now, if we move on to the next slide to just put the global environment into context, I think what we saw was 3 simultaneous shocks. You had the coronavirus and the associated lockdowns with a big portion of global productive capacity being in lockdown. At the same time, you had the oil price collapse. Now, one always thinks the oil price just affects the petrol price, but the oil price is a big dollar liquidity provider as well. And as the oil price collapsed, your dollar liquidity also started drying up. and that also led to a freezing of capital markets. So initially there was globally there was a run to safe haven assets, being US treasuries, the US dollar, gold. And as the capital markets started freezing up, you actually even saw those assets becoming under pressure. And that's why we started seeing emergency liquidity injections by governments across the world. Now, the economic impact of that's been that there's a synchronized global GDP slowdown. You're seeing a record unemployment. I mean, it's multiples of what we saw during the global financial crisis. The flight to safety is resumed. So US treasuries, gold, stocks being the beneficiaries. And even the FANG stocks have actually held up well, sort of internet-related online businesses that can continue to operate under the lockdown conditions. So the likes of an Amazon, a Netflix where people watch at home, a Tencent in our context have also done well. And we've seen a massive sell-off in emerging markets, including South Africa, and it's been widespread. It's not only the equity market, it's been the bonds, the equities, and the currency. So emerging markets also taking a lot of pain. Now, if we look at the SA environment, I think if we look at how we've approached the coronavirus, it's been, I think, an exemplary response. One that I think the world will take notice of in terms of how professionally and efficiently it was done. But can we really afford it? It's a real first world response in a third world. I mean, we went into this crisis in quite a weak position in terms of our balance sheet and income statement, and this has really just pushed us right to the edge. Now, I mean, we know the first lockdown was extended with another 2 weeks, which is ending next week. And it looks like, if we look at the early plans that's been circulating, is that the release from lockdown is going to be in 5 stages, almost like Eskom's load shedding, with different levels of freedom at the different stages. Now, currently we're at level 5. It goes all the way to level 1. And there will also be a differentiated approach across provinces, depending on the severity of the corona pandemic in the different regions. So I think the lockdown is going to remain for a while. Now we've announced a 500. President Ramaphosa has announced a 500 billion rand economic rescue package. Which is basically repurposing of a lot of spending that was going to happen. So the true additional spending is not that headline number, but it's still a substantial amount. Now, the question one has to ask is, if you look at that 500 billion, if you look at the lost tax revenue, if you look at the economic cost per day, and you say, what now, one can't put a price on a life, but if you look at the lives saved because of our draconian approach to the pandemic, I mean, is that cost justified for the economic livelihoods that will be lost because of the lockdowns, and the lives that will be lost through famine and through just financial hardship? It's a very difficult call to make, so we can just pray for our government for guidance during this time. But it's a very tough to make the right call. But I think if we don't open up soon, it could have catastrophic impact on our economy and on our companies. Now, the one positive from this is that we are starting to see reforms happening, and I think it has strengthened President Ramaphosa's hand in being able to force through reforms. It looks like the moderate camp in the ANC, where there's also less corruption, is being strengthened, and we've started to see signs that there's hard action on SAEs as well. I mean, there are three things that I can refer to: the SAA business rescue practitioner that's applied for more funding, and the government said no, there's no further funding available. The land bank that didn't get an additional capital injection because of notes that are due that they have to repay. So they have to. The government wants them to get external funding for that, and Eskom declaring force majeure on Exxaro for coal contracts. Now it's got implication for the SOEs and for related securities, but the one positive is that there's no. I think those days of just throwing more good money after bad is over, because we haven't got the capacity to do that anymore, and we're almost forced into having to do reforms. Now, that funding of the recovery package was also the question of where we're going to get the funds, and there was a big pushback against approaching the IMF or the World Bank, and it seems like we will be approaching those institutions for funding, which again I think is a positive, because it will be coupled with conditions of reform, and on the one would be looking at the state's wage bill, which has been growing at inflation in real terms by 5% for a number of years, and now for the first time it looks like government is being forced to address that. Now the outlet for all this pressure has been the rand, and I'll show you one or two slides on the rand, because the rand has sold off from 14 rand to the dollar at the start of the year to 19 rand currently, and it looks a bit extreme. It's one of the most liquid emerging market currencies, so it's also used as a proxy for other emerging markets, but it looks like the rand sell-off is overdone. One can't see an immediate catalyst for a turnaround of that, so it could stay a bit here, but it is very extreme in terms of the level of weakness. So I think the rand is, from this level, one must be careful to see it as a one-way bet that the rand will just continue to weaken. Now, if we look at the markets, initially the market sold off heavily. It rebounded quite strongly from mid-March into April, and more recently starting to trend water. I think the question is, are we going to see a second wave of selling as the true economic impact starts emerging when companies report results, or will the markets look through that and say, well, we know the reasons for that, but there's all these massive economic stimulus programs across the world, and if things return to normal, we're going to see a V-shaped recovery, and because of that, a lot of companies are cheap, and we can buy. And what's going to be that catalyst for that recovery? Now, I think in my view, the catalyst will be if the market starts getting a sense that this corona pandemic has really been dealt with decisively. So that means that a proven vaccine is developed, or that there's no fear of a re-emergence of the virus when lockdown ends and economies start opening up. So we are in an experimental period where countries are starting to lift some of those lockdown restrictions. So I think the next 2-3 weeks will be critical in assessing whether the lockdowns were really effective, and if economies get opened up again, if we just don't see a resurgence of the pandemic. So just looking at the graph on the rand, and here I've graphed the rand versus the emerging market / commodity currencies. So that's not against the developed market currencies. So this is our peer group of markets that's got similar export drivers or in similar territories. And you can see we now, relative to that basket, that composite, we at levels where we were during the global financial crisis. So even against our peers, we look very oversold. On the next slide, we graph the rand on a purchase price parity basis, but then adjusted for fundamentals. So on the vertical axis, that's just a pure valuation, and those numbers on the side refer to standard deviation. So I mean, we are more than 1.5 standard deviation cheap, but in terms of our fundamental score, which would be our growth, current account and fiscal deficit expectations, we rank very weakly. But you can see of all the currencies, we are in this graph, we are one of the cheapest cheapest currencies, but with one of the weakest fundamentals. But that is more than priced in. I mean, that blue line is adjusting for that. So we do think we are slightly oversold. So reflecting on the fair values then of the different asset classes, if we go back 12 months, there were a lot of asset classes that were in the fair to expensive bucket, and we've seen a big shift into the cheap bucket. So in the expensive bucket, it's your let's call it corona safe asset classes: developed market bonds, developed market credit, and developed market cash, specifically US. In the fair bucket, US equities have moved from expensive to probably fair, somewhere between fair and expensive, and some commodities are now at fair levels. I mean, there's some that are cheap leveled, and specifically oil. I mean, the average cost of production of oil in the world is $55. So at the current level of around $20, we're going to see massive supply destruction happening. So curtailing oil production, which in time could lead in a substantial rebound in the oil price. So for the strong oil players that survive, and we would think Sasol, being on the lower part of the cost curve, would be one of those, if they can manage to protect their balance sheet through the stress, could actually emerge as one of the winners post the oil crisis. But elsewhere in the cheap asset, almost any SA asset class that you can look at, equities, bonds, property, SA cash, still relative to the world attractive even after the 2 rate cuts, and hybrids also looking attractive. And by hybrids, I'm referring to sort of preference shares and convertible bonds. So if we look at how the fund is positioned at this point in time, you'll see we've got 43% in SA equities and about another 15% in offshore equities. So relative to our mandate limit of 60%, we are quite fully invested at this point in time. SA bonds at 13%, we're also at the moment getting quite an attractive real return. We have started increasing selectively our property exposure, convertible bonds and prefs at about 5%, and then offshore sitting with about 15% in equities, 8% in offshore bonds, and those are not developed market bonds. Those are SA names where we get a very nice yield pickup in hard currency, and then offshore cash at about 8% and very little offshore property exposure. So looking at our top positions, top equity positions, Naspers remains our biggest position, and we've got an 8.8% position in Naspers, of which you'll see in brackets it's 1.8. That's after taking the hedges into account. We've got quite a few hedges on Naspers. ABSA, our next biggest at 3%. ABSA's been very hard hit and currently pricing in basically zero earnings for the next year, and then 40% lower earnings than last year for the next 3 years, and then only growing at 10 to 12% after that for the next 10 years. So only getting back to what they were earning in 2018 in 15 years' time, which we think is quite an extreme position. We acknowledge the near-term headwinds for the banks, but for any economic recovery globally and in South Africa, you need the financial system to work, and we've got actually one of the most efficient financial systems and most well-regulated banking sectors in the world. So we do think our banking sector will emerge from this crisis. It will take time, but currently a lot of the negativity in our view is already discounted in where the banking shares are trading. So we've retained our banking exposure, and it's mostly through ABSA, Standard Bank and Nedbank. We've also got Prosus, which is another play on Naspers, but also you'll see after hedges only 0.9%. The Sasol, we've still got 2% in the portfolio. Now the question is, if we're so positive on Sasol, why haven't we bought more? We do acknowledge that there is risk of them having to do a capital raising and a rights issue, which could put further pressure on the Sasol share price. But the way we look at Sasol at the moment, your downside risk is that you can maybe lose half your money from here at the current share price. But if the oil price normalizes, and as I said, we do expect to see quite a bit of supply destruction, then Sasol could be trading about 300 Rand a share again. So your downside is maybe 50%, whereas your upside is 500%. So it's almost like a call option at this point in time. But we think from a risk-adjusted perspective, a 2% position is sufficient. I've also listed the rest of the top 10 there, but maybe I'll open it up for questions at this point in time.
Sorry, everyone, I was on mute. Omri, thank you very much. That's a really comprehensive rundown of what's been going on in the fund and around South Africa. Can I remind everybody there's a Q&A option at the bottom of your screen. You can go into there and submit any questions. I've got a couple to go through now. If you would like to drop off at this point in time after the prepared remarks, please do, and thank you very much for joining. But I'm going to keep Omri on the phone for a minute and run through some of the questions we've had and get some insights, some additional insights from him. So, Omri, the first question, we're going to go right back to the beginning of the presentation.
Yes.
It's on the Euro Stoxx notes. And so a couple of questions there. So the impact of the Euro Stoxx notes on the fund are because the price of those had been marked up on the strength of the performance of the Euro Stoxx index, right?
That's right.
So now what you're seeing is a reversal of that. As the Euro Stoxx index fell, it has to be marked down in the price of the notes. Is that correct?
That's correct, yes.
And so then how does that play out over the next year or so? and the question we had through our Q&A is when do the notes expire?
Okay, those are good questions. So typically these notes are 5-year notes, but you every year you assess where they were relative to the start. Now, in one of the notes case, there's still that was deeply in the money. That there's another 3 years left on that note. So, but it was going to expire now because it was way above the level where we participate in the upside, and that's why there was so much accrued value in there. Because of the collapse of the Euro Stoxx, now it's way below that level. But we've got another 3 years to go on that note. So if the market grows slightly, let's say 1 or 2% a year for the next 3 years, then on that note, our return will be about 17% per annum to basically recoup our or as the capital protection kicks in. If the market continues to fall and it's say down 20% over the 3 years, so let's call it 5% or 6% a year, you will on that note see the same impact. So that's the worst case scenario in line with the market. I think a base case scenario is that we're going to see 15 to 17% return. And if we do see a bit of a stronger recovery in the market back to above that level, then suddenly we have to catch up 5 years of coupons that we've missed out on. And then your return goes up to close to 30% a year. So in our view, on a risk-adjusted basis, that basket of notes is now very attractively priced, where your risk-return ratio is very much to the upside. Your downside is at worst in line with the market. The base case is that we see a recovery back to the capital protection levels, and the upside is that we see recovery back to the capital protection levels, plus then the recoupment of the coupons that once missed out on. So at the moment it's just over 5% of the portfolio, but we think it's one of the more attractive asset classes within the portfolio.
So it sounds a bit too good to be true there, Omri. So what are there any hidden risks that we should be aware of?
Yeah, it sounds too good to be true, Rob. It's because we've taken the pain already. So I mean that is in the performance numbers. So I mean, which was very disappointing. I mean that was one of the assets that we thought was going to protect capital, but because that fall was so rapid, I mean all that accrued value. So it's nice to have that capital protection, but if your asset is trading way above that capital protection value, which is why you bought it, that's what was the bull case you were hoping for, but suddenly all that accrued value disappears. So now we're at a level where it's almost like a bond, and you get a pullback to par, and then but if there's a stronger recovery, you're going to recoup those coupons that you've basically missed out on now.
And last question on the Euro Stoxx, is there any risk that the issuer of the notes doesn't make good on the promise?
So there is counterparty risk, obviously, with who you hold the note with, and that's why we have spread it with 4 different counterparties. And the counterparties that we've got it with is all investment grade counterparties. So I mean, we're not at this point worried about the counterparty risk associated with the notes. Okay,
thanks very much, Omri. It's interesting in your presentation that you mentioned, flight to safety, and within that you referenced the FANGs. It seems a bit
Yes,
unusual
it is.
to
Yeah.
have those two in the same sentence. What's your view? What's your view on why high growth companies are being viewed as a safe haven?
That's a very good observation, Rob. And I mean, one wouldn't normally put that in the safe haven category, but I think the market is currently paying up for secure growth. Any company where the growth has not been that impacted, the market's willing to pay up for. And the FANG stocks, those are internet-related online ordering services with typically lower capital, and where they've been able, because of the nature of their services that they offer, they've been able to continue to operate. If you think of Amazon, I mean, they've, in the last 2 months, they've hired an additional 200,000 workers to cope with the workload in terms of their online ordering. I mean, Netflix has seen a 30% growth in their subscriber base because of people being under lockdown and watching more movies and TV series. The same with a Tencent, and that's why I think you've seen those stocks being regarded as safe haven assets. In the South African context, it's been stocks like Clicks, which has been able to continue operating under lockdown because of the nature of what they sell. MultiChoice has actually held up reasonably well, and Naspers has been a star performer on the back of Tencent's continued strong performance.
Okay, thank you. And a couple questions that have come through. You've increased your holding to PSG recently.
Yes.
With the cautious statement they issued this morning, I believe. Are you expecting any action there, or
yeah, that's a good point. So we had 0% exposure to PSG, and into the big sell-off that we saw on Capitec, when Capitec went down to 650 Rand. At that point in time, our view on PSG was that just their shareholding in Capitec was at that point 120% of the PSG share price. And then you got Kiro, Stadio, and all the unlisted assets basically for free. So in terms of the true NAV of PSG, that was 160% of the PSG share price, and we bought quite a few PSG shares into that weakness. Now they've come out this morning with a cautionary statement saying that there is going to be some corporate action. So there's a lot of speculation what that could relate to. The one is that they could look at unbundling the Capitec shares, which effectively then PSG should be trading at a negative value, because Capitec is worth more than just what they own in PSG is trading at less than just what the Capitec shares are worth. The other thing is that maybe they look at buying out Kiro, because Kiro has also been under a bit of pressure. So at a stage, Kiro was also up 13%. And then Zeder has also had some corporate action where they've paid a huge special dividend to shareholders, and the remaining assets are now trading at close to a 50% discount to net asset value. So it could also be that they're just going to buy out minorities in Zeder. So we don't know what the thing is, but you are dealing with some clever investment bankers at PSG, and our view was that this discount to net asset value could also be a catalyst for them to try and unlock value. And I think the share's up about 12% today, so that will help a bit today.
That's good news. And if we look at the fixed income side, have you been adding to the SA bonds in the portfolio as the yields have pushed out?
Yes, we have increased duration at the higher levels. I mean, we do think that it's going to be one has to be a bit tactical on bonds, and you're going to get your opportunities to buy and sell. So I mean, we don't want to extend duration too far, but at current yields, we think it's fair to cheap. So we have added some bonds and added some duration.
Okay, thank you. There's a question on the rand, and I'm just going to take the presentation back to slide 5, where
Yes.
you had the rand versus the basket of other EM currencies. Why does the rand sell off more during times of crisis than other EM currencies?
That's a good question, and I think the biggest reason for that is that the rand is one of the most liquid emerging market currencies that's out there. In fact, I think it's in the top 10 most liquid currencies in the world, even given the size of our economy. So the rand, a lot of times, is actually used as a proxy for other emerging market currencies. And that's why during times of crisis, the rand almost also overreacts a bit. In times of positivity, the opposite, obviously, when people are scrambling for risk assets, the rand is a beneficiary of that. But I mean, we're not alone in having major headwinds. I mean, most emerging markets have. So, but global macro investors use the rand as a proxy to also hedge some of their other emerging market exposure.
Okay, thank you. And with your exposure to offshore assets, then are you hedging any of that dollar risk?
Yeah, so we have put in some hedges on the rand strengthening, and again, because of the volatile nature of the rand recently, those hedges are actually very attractively priced. The market is currently pricing that the rand will just continue to weaken in a straight line from here. So to protect against the rand strengthening is actually very attractive at this point in time. You can get deep hedges and still participate in quite a bit of rand weakness should the rand weaken. So we have hedged quite a bit of our dollar exposure. And then also on our offshore equity exposure, we've also got a put on the S&P 500, and then those Euro Stoxx notes, as I said earlier, they've got their capital protection levels and trading at quite a bit below that. So if there's a bit of a recovery, we will see a reversion back to those capital protection levels, which could be a nice source of return for the fund.
Okay, thank you, Omri. And there's a question on property. You mentioned that you're increasing your local property exposure. Is it too early to do that?
Yeah, I think one has to be very selective. So our exposure has been to the sort of higher quality of the spectrum, and also specifically where there are property companies who've got two-tiered capital structures. An example would be the Pula, which has got an A and a B structure, and the B unit holders take the first hit, and only then the A unit holders. Now, in the property sector, I mean, your normalized yields are now starting to run at over 20%. So we do think there's still quite a bit of pressure on property companies, but in terms of discounts to net asset value, in terms of normalized yields, we think there is nice value is starting to appear.
Okay, thank you. And then last question we've got is, if there's a second wave of sell-off locally and globally, what's your opinion of how well the portfolio is protected from here?
Yeah, that is a good question, Rob. I mean, we are trying to use this opportunity into any strength to rotate the portfolio into securities that could withstand a second wave. So examples would be stocks that we see could withstand that would be stocks like British American Tobacco, which we think will continue to generate cash and trade well. It would be things like the PSG preference share, which is now approaching 15%. So PSG sell very little debt. So very high likelihood that dividend will still be paid. And then opportunistically, there are some shares, and an example would be an MTN, where because of the nature of lockdown, people are consuming a lot more data. And year to date, Vodacom is actually up. MTN is down almost 50% on the back of concerns on Nigeria. But in our view, Nigeria is now priced at a negative value. So if the lockdown continues, and even if it eases up slightly, people will continue to consume data. So MTN also a good example. So yeah, I think we are trying to increase the, call it, defensive quality side of the portfolio into any strength.
Okay, thanks very much, Omri. That's all the questions we've had through. Thanks for your time today. I think it's been really comprehensive run through the portfolio and how you're positioned. So I really appreciate that, and I hope you keep well. So thanks again.
Thank you to everyone that's phoned in, and keep safe out there. Appreciate your time.
And also from me, thank you everyone for joining once again, and apologies for the dog noises in the background just then. There is another call tomorrow with Truffle on Nedgroup Investments Balanced Fund, so please join us again tomorrow. But on that note, thanks very much for joining. I hope you found it interesting, and have a fantastic rest of the day. Bye-bye.